ETrade just launched 5 brand new no-fee funds. Are they worth investing in? Hello, members, super savers, and bond course fans. I hope you're healthy and well. So here's another one that crossed our desk recently. ETrade's no-fee index funds. These 5 new no-fee index funds offer you the expertise of Morgan Stanley Investment Management with 0% expense ratios, no minimums, and no commissions. This doesn't sound too bad for potential investors. ETrade and Morgan Stanley are respected names in the industry, and who wouldn't like a strong product with 0% expense ratio, no minimums, and no commissions, right? That said, and because we're a curious bunch here at Diamond NestEgg, we couldn't resist diving a bit deeper into this new ETrade offering to better understand how the setup works, what the potential drawbacks are, and whether the funds may be a suitable investment for some in our community. So, with that in mind, here are the 3 topics that we'll be covering in today's video. 1. How do no-fee index funds cover their cost and make money? 2. What no-fee index funds does ETrade offer, and what are the restrictions? And 3. Would we invest in these no-fee index funds? In this section, we'll also talk about how these new no-fee index funds have performed so far. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. How do no-fee index funds cover their cost and make money? All retail funds that we know of are set up so that the fund manager basically pays for all the expenses of the fund, out of pocket and on the behalf of the fund. These expenses include all trading, administrative, and custody costs. In return for paying for the fund's expenses and running the fund more generally, the fund manager charges its fund investors a fee that is set as a fixed percentage of assets under management. This is the expense ratio that many in our Diamond NestEgg community are familiar with. The expense ratio for most standard retail funds is measured in basis points and usually relatively small, especially if the fund is passively managed. And this setup where the fund manager pays all the expenses but also receives a fixed fee from its investors is done in order to align the interests of both parties. The thinking goes that there will be no incentive for the fund manager to spend investors' money freely because the better the fund is managed and the less it spends, the more remains left at the end of the year from the fixed fee, which is essentially the fund manager's profit. Now, the new ETrade no-fee index funds are set up like these other normal funds in the sense that the fund manager will pay all expenses for the funds. The fund manager in this case is Morgan Stanley Investment Management, or MSIM for short. Because these are no-fee funds, though, MSIM will not charge anything to the fund's investors. The expense ratio is 0%, as we can see from all these zeros here in the prospectus. And as the prospectus continues, this results in an arrangement where the advisor does not receive a fee from each fund for management services and pays the expenses of each fund with limited exceptions. But why would Morgan Stanley Investment Management do this? Or, as some of you have asked, are there perhaps some hidden fees that the fund's investors end up paying anyway? So, to be clear, under the terms of this arrangement, MSIM, as the fund manager, will pay for all trading, custody, and other administrative expenses. Yes, there are some exceptions, such as for litigation, but these are very limited, meaning that there are basically no hidden fees, and it would be against the terms of the prospectus for the fund manager to try to sneak any other hidden expenses to its investors. How do the fund managers cover their costs then, right? Well, they'll do 3 things essentially. First, they will try to minimize expenses even more than for some fee-charging funds. For example, these no-cost funds here are really all passively managed index funds that will have limited trading expenses. They will also use the existing infrastructure of ETrade and Morgan Stanley as much as they can. And they will pay attention to detail. For example, ETLGX, the no-fee large-cap index fund, is tracking the sole active GBS United States 500 index from a Frankfurt, Germany-based provider, which may be a tad cheaper than the license fees for using the better-known S&P 500 index, we suspect. But of course, there will always be a certain amount of unavoidable expenses that the manager will have to pay for. That's just the cost of doing business. And to repeat it, MSIM will not be able to recover these costs from fund investors. Second, the fund manager can participate to a certain degree in revenue streams that the fund generates. This is foremost securities lending, where the fund lends out some of its securities for a fee to other market participants for a certain time. Now, the income generated from securities lending belongs to the fund investors in the first place, but very often the fund investors will split this revenue with the firm. Let's take an example again and say that ETLGX engages in securities lending to make a bit of extra income for its fund investors. That's quite a work-intensive undertaking and involves tracking the shares, managing the collateral, and monitoring the payment flows. So the fund may need some support from ETrade and Morgan Stanley and split the securities lending revenue with them in return. But while the income from securities lending that the fund will share with ETrade and Morgan Stanley will help a bit, it will most likely not be enough to cover the entire expenses, even after all cost-saving measures. We could not find any hard data, but we agree with many industry observers and strongly suspect that no-fee funds may de facto not be a profitable product for any fund manager, which leads us to the third point here. The most important motivation for why firms may offer no-fee funds in the first place is that they probably treat them as loss leaders, products that may not be profitable by themselves, but are expected to bring in new clients and business that will eventually generate sufficient new revenue to cover the initial shortfall and then some. And this is not so different from the special offers in your supermarket that lure you into the store in the hope that you may also pick up some full-price items with a healthy margin once you're there. But of course, if a fund manager launches no-fee funds as a loss leader, they would presumably try to design the offer in a way that makes them attractive for the audience that they want to attract, while at the same time restricting the expected direct financial loss as much as possible. Which brings us nicely to the next question for today's video. What no-fee index funds does ETrade offer, and what are the restrictions? Given what we just discussed about the likely economics behind no-fee funds, it should come as no surprise that the ETrade no-fee fund range is limited and has some additional restrictions on top. Let's start with the fund range. It's only 5 no-fee index funds at this point, but they are well selected to cover some of the basic investing building blocks that most investors would consider. The Large Cap Index Fund, ticker ETLGX, tracks the sole active GBS United States 500 index, as I already mentioned before. So for most retail investors like you and me, it should perform comparably to an S&P 500 fund for most practical purposes, if you want exposure to the largest 500 companies from the US stock market. The Total Market Index Fund, ticker ETTOX, tracks the sole active United States 3000 index, giving you exposure to the largest 3,000 companies from the U.S. stock market, including mid and some small caps. It should behave similarly to the Russell 3000 index for most purposes. The International Index Fund, ticker ETISX, basically tracks the sole active GBS Developed Markets ex-United States Large and Mid-Cap USD Index, NTR, or net total return, which is a fancy way of saying that it includes international developed markets companies, but excludes the US. Do note that this fund represents approximately the largest 85% of the free float market capitalization in the developed markets, excluding the United States, which means it may include mid and some small caps as well in regions such as Europe, Australia, and Eastern Asia. This may be an option if you want to balance your U.S. stocks with some international exposure. The Municipal Bond Index Fund, ticker ETMUX, tracks the Bloomberg Municipal Managed Money Intermediate 1 to 17-year index. It includes tax-exempt municipal bonds rated in the top 2 ratings categories of AA and AAA, with maturities between 1 and 17 years. One aspect to consider here is that this fund reflects the entire U.S. municipal bond landscape and is not focused on any single state, which may be less tax efficient if you're an investor based in a location where you may still have to pay state and local taxes on out-of-state municipal bonds, even if they are otherwise exempt from federal income taxes. And last but not least, the U.S. Bond Index Fund, ticker ETBOX, which gives you exposure to U.S. government and corporate bonds. As per the end of April, it was made up of about 62% government and 33% corporate bonds, with the rest in cash. So far, so good. These seem to be 5 funds that may not allow you to customize your portfolio too much, but that might well be something to look at if you're looking for some fundamental core building blocks for a diversified portfolio. And for no fee. But as our Diamond NestEgg regulars hear me say often on this channel, there's no free lunch in finance, or in life for that matter, meaning that there are 2 restrictions or conditions that you should be aware of before you decide to jump into any of ETrade's no-fee funds. First, these no-fee funds can only be purchased through a self-directed account at ETrade, so you need an ETrade account to buy any one of these funds. Although the good news is that there is no minimum initial investment amount. And the second restriction is that the shares of the no-fee funds cannot be transferred to financial institutions other than Morgan Stanley Wealth Management, which means that you will always need a brokerage account with either ETrade or Morgan Stanley as long as you're invested in these no-fee funds, or you'll have to sell your shares and buy a new fund with another broker. Now, I think I understand where these restrictions may come from. It clearly looks like ETrade, Morgan Stanley, decided to subsidize these no-fee products only for people who bank with them and who may want to buy some additional products from them going forward, so to speak, which is a legitimate approach in business, by the way. But it's nonetheless something you need to keep in mind before investing. And that brings us nicely to the next section of today's video. Would we invest in these no-fee index funds? These ETrade no-fee funds are all still very young. They were all launched on April 11th, 2025, so just a few weeks ago at the time of this taping. Nonetheless, let's have a quick look at their performance so far. In this column, we have the name of the ETrade no-fee fund. In this column, we have the ticker. And in this column, we have the AUM, or Assets Under Management. As we can see, all the funds are still pretty small, with AUM of between $13 million and $18 million. In this column is the net asset value, or NAV per share, essentially the share price. And in this section, we have the 1-month trailing returns on an annualized basis for each fund from Morningstar, as well as Morningstar's performance numbers for the category and the index. For what it's worth, after such a short time, the 1-month trailing total returns look roughly where we might have expected them. When you compare the numbers, do keep in mind that Morningstar's category includes a wider variety of similar funds that may have a slightly different risk-return profile than these here. In addition, the indices shown for comparison may also be different from the indices that ETrade's no-fee funds follow. Personally, I think we may need a bit more time to get to a more robust track record for historical comparisons, but I would in any case say that at this point, none of these trailing return numbers raise any red flags for me. And from what we've seen so far, these ETrade no-fee funds seem to be soundly constructed and are sold and managed by 2 respected firms in the market. So in that sense, you probably wouldn't go really wrong if you wanted to try them out in this early stage, so long as you're comfortable with the fact that they will tie you into a relationship with either ETrade or Morgan Stanley as long as you own some shares. Meaning that if you ever left for another brokerage firm, you would have to liquidate your position in their no-fee funds, as we discussed earlier. Marcus has been an ETrade customer for many years now, and when I told him about their new no-fee funds, he actually thought it wasn't such a bad idea to have some new exclusive no-cost funds to choose from. That said, for the equity index funds that we regularly invest in, there are already some competitive products out there. For example, for our regular investments in U.S. large caps, Fidelity's FXAIX at 1.5 basis points or Vanguard's VOO at 3 basis points are not that expensive after all, even if compared to a no-fee fund. And they've been around a lot longer. And as for ETrade's no-fee bond funds, many of our Diamond NestEgg regulars know I'm generally not an avid investor in bond funds. I prefer to buy individual bonds and hold them to maturity. So these really aren't for us. But that's me. And as I always say, everyone's financial journey is different. What do you think? Are you tempted to add some of these new ETrade no-fee funds as building blocks to your portfolio? Or do you feel that the restrictions on a potential transfer to another broker are enough to keep you from investing? Or do you already own other no-fee funds with other brokerage firms, like Fidelity, for example? And what is your experience? Drop a comment below and let me and the community know. And in case you're not an ETrade customer, but are considering opening up a new brokerage account with them, either to check out these ETrade no-fee funds or simply to explore another platform, then this video here from Your Financial Journey is for you. Caitlin walks through ETrade's sign-on bonus for new brokerage accounts if you deposit more than $1,000. All right, members, super savers, and bond course fans, I hope you enjoyed today's video and learned something new. And as always, if you want to keep learning about bond investing and building out a bond portfolio, then check out this video here on our bond courses, especially while rates are still attractive. I've also linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.